It's the Real Estate Podcast, brought to you by ANZ Home Loans for financial well-beings.
Hey, welcome back to another episode of the Real Estate Breakfast. Hey, we are well and truly into 2025. And coming up in just a moment, we are back into our time tunnel. We are travelling back to August of last year. I wonder what was happening. We'll find out that next.
You're listening to the Summer Series on the Real Estate Podcast.
Let's go back to these properties, $750,000. You're saying that the trick in securing a house with that budget is knowing, of course, where to look. And that could mean having to search a little bit further out from the inner city. And that is the key, is where to look.
Absolutely. And I think $750,000 also looks very different depending upon the capital city in which you're purchasing. Obviously, $750,000 won't go as far in a market like Sydney that has a $1.66 million median house price. But somewhere like Perth, where the median house price is sitting at about $850,000, $750,000 will get you much closer to the CBD relative to what you could purchase in Sydney. And I think, we were talking about house prices here, and I do think, the Australian dream is to own a home. I think we're seeing a little bit of a reshaping of what that Australian dream looks like. I think we're seeing more of us live in apartments and units. More of us live also in townhomes, townhouses or terraced homes. But I do think that people do strive to purchase a house. It's that quarter-acre block. It is that foundational dream that has, been a pillar of our housing markets for many, many years. It is being reshaped quicker in some cities that are much more expensive. But I do think the key is knowing where to look, but also knowing the market dynamics, because it is a really timely reminder that we have multiple property cycles going across Australia and even within cities. So you can find that market dynamics at a suburb level can be very diverse. The west of Sydney will perform differently to the inner and the CBD areas. So it is knowing what is it a seller's market? Is it buyer's market? Does that favour your negotiation power? Making sure you're in tune with what's happening at that localised suburb level that you're interested in purchasing in.
It's really fascinating if you go back 10 or 15 years, because I know that you're tracking this, and that is the units versus the houses. And those investors, some investors only looked at the units. Many people at the time would have said, well, you're better off to, buy houses because of the appreciation, et cetera, et cetera. They were buying in a lot less. But now, if these people bought, 10, 15 years ago, these apartments, these units, they're sort of laughing all the way because that tightness between those two markets has changed forever now.
It is, and I think you tend to find investors do go towards units. It makes up the bulk of the rental market. They're obviously much more affordable, therefore holding costs are much better. And, it does form, units do form the basis of the rental market's the largest pool. And you tend to find most rental stocks are in that kind of inner and middle, particularly the inner suburbs. But I think when you're thinking about capital growth, investors get into the market for capital growth. You generally find that houses do perform better in terms of capital growth over that longer term, because ultimately the value is in the dirt, and it's the asset, the home on it, the asset on it that depreciates in value, and it's the land component that improves in value. But I think we've seen a rise, we're talking about affordability, we've seen a rise in first-home buyers becoming rentvestors, which means is a term that means you continue to rent in the area in which you want to live, and then you purchase and become an investor, technically a rentvestor, in a more affordable market and lease that property out. That's been a rising trend, particularly in a market like Sydney, which has great affordability barriers to gaining entry. But, there is a diverse array of housing across our cities, and generally speaking, that affordability for houses increases the further away you get from the CBD, and that's largely because of that land component I was just talking about. Land is more valuable and comes at a premium in inner city suburbs.
Every week, we present so much real estate.
Yes, we're not 100% sure whether they sell because of cost of living pressures or whether they sell because they feel that housing won't be as attractive of an investment compared to other investments. That does not necessarily just mean the profit margins, but also just the nuisance of those investment properties or just second homes. They do become, of course, expensive, and you go, well, maybe this is not the right time anymore. In those regional markets, that might be a bit of a welcome development because these markets were driven up massively during the pandemic. We saw big increases in house prices. These house prices, of course, priced out low-income local workers, and the local youth that potentially could have settled in the area did not so, or stayed at home with mom and dad for longer. So these developments now get softened a bit, but of course, in comparison to pre-pandemic levels, we're still talking about elevated higher prices here. So it's not that housing in Mansfield or on the Basque Coast is all of a sudden dirt cheap and super affordable. It's just that a certain segment of buyers is leaving the market, and then this leads to relatively strong drops because in small regional markets it only takes a couple more people wanting to move in, what we've seen during the pandemic, or now a couple of people wanting to sell, making more housing available, and then those markets react relatively strongly in either direction from a price perspective.
Well, Craig, I think mortgage holders would breathe a sigh of relief after the inflation numbers that were published yesterday. And the reason being is that this inflation report was largely seen as a bit of a make or break report. There was some in the market that thought if it's an ugly number, the RBA may be forced to hike rates again. I think they would be a very reluctant hiker, and the threshold for another rate hike is high. But in the event, the headline inflation numbers came in line with expectations at 3.8% for the June quarter, or the year to the June quarter, I should say. And the underlying inflation numbers, which I think get more attention and dampen the impact of those prices that move around a lot, well, that moved a little bit under expectations. So it moved from 4% in the year to the March quarter to 3.9% in the June quarter, and is only a smidgen above the RBA's own forecast, which I think will give the RBA breathing space to leave rates on hold for now.
So there's really no reason then for the RBA to look at hiking this up next Tuesday from your point of view?
Look, I think they'll certainly discuss a rate hike. The last time they met for a board meeting, they discussed whether to leave rates on hold or whether to hike rates. Given that the underlying inflation rate is a tad above their own forecast, I think that a rate hike will still be discussed. But they're reluctant hikers, and you are seeing weakness in other parts of the economy, particularly with discretionary spending by consumers. And we saw more evidence of that in the retail sales data yesterday that was published. So, look, I think on balance, the RBA would be comfortable to continue to leave the cash rate on hold and wait for further information.
I know that you were the former chief economist at Westpac Business Bank. All sorts of different theories from various banks around Australia when it comes to a rate cut. What camp are you in personally? Do you think that we're likely from the RBA to see a cut before the end of 2024? Because some of these banks are now saying by the middle of next year we can expect one.
There's certainly a divergence of opinion. My own view is that there's a good chance we could see a rate cut late this year or early next year. If we have a look at market pricing, which gives us an idea of what interest rate markets are attaching to a rate cut, before that inflation data, a rate cut around May of next year was fully priced. That's now been brought forward, and there's about an even chance of a rate cut in December. So markets don't see a rate cut before the end of this year as a done deal yet, but certainly after the inflation data, the bets on a rate hike have really dissipated.
I guess the whole question is around what do investors do if they're considering the fact that their properties are now not really returning enough to cover their costs. Well, welcome to the old days, and this is how it always was when we invested in property. I think I built the bulk of my portfolio during a time when standard interest rates were 8 or 9%. Rental yields, if you could get them at 5 in an area that might have had good rental yields. And you always had that gap that you had to fill in from your own pocket. The marketers used to always market properties saying, you can invest in this from as little as $50 or $60 or $70 a week. And that meant that that's the shortfall. That's the amount of money that you had to pay. There's a couple of things that investors can do, and they have to think about these as well. If you do an upgrade to your property, the capital cost might be X amount, but then you get depreciation benefits from that, which will increase your on-paper costs, get more tax back for you, and help to fill that gap just a little bit. So often people they might have a loan on a property, they might increase that loan by a little bit to carry out some renovations, and then because they are the first owner of that plant and equipment used in that renovation, they can get a bigger tax deduction.
Last week, that very question, I asked Jeremy, a property investor in Brisbane, if he knew of other investors who were selling off any of their stock. And this is what he said.
Yeah, I do. I mean, I've got a friend of mine who went nuts during the property market boom and leveraged against the other. And he ended up with more than 20 properties. A lot of them were in sort of outback towns, smaller prices, which have obviously been feeling the pinch a lot more than the CBDs. So he's having to let some go. And other people are feeling the pinch. I think the report said the other day there's over a million Australian households who are in mortgage stress. So they may be late on one payment. They may have skipped one payment because of the cost of the mortgages have gone up, and they're having to reevaluate. Do we sell, or do we actually cut back our lifestyle? Do we sell the extra car so we can actually pay the mortgage for this month? People out there are feeling the stress. Yeah, absolutely.
So, Margaret, I found that really interesting for a couple of points. Obviously, selling off some of the stock, but I don't think it can be underscored too much that people, since COVID, some people have really sort of rocket turbo fueled up their portfolio. Some people didn't even have a portfolio, and that case there alone, his friend, 20 properties since COVID.
There's 3 shows out of that soundbite. I could discuss that particular soundbite forever and draw some really important lessons for property investors out of what he's saying. A friend who bought things mainly in outback towns. Well, my first question would be, why did he only buy in outback towns? That's not diversification to me. And if he did buy in outback towns, did he ask the important questions about those towns to establish that they would have a future that would be conducive to being a property investor? So it's fine to just say, well, I'm going to buy out in Whoop Whoop or wherever because I can buy a property for $150,000 and it'll rent for $500 a week. That's fine. But if that property never ever grows and doesn't have the growth drivers in the area to make that property grow in value, it's not a good investment. And at some point in time, you'll probably struggle with that mortgage if interest rates go up. So people dived in using, to me, the wrong basis on which to invest. There's some basic fundamental property investing lessons that people need to understand, apply, regardless of whether the market is booming or falling. And those fundamentals will mean that you can buy a property and not have to suddenly get stressed out and have to sell off. This fellow who bought the 20 over-leveraged, obviously, on properties that were never going to be able to grow in the first place, or probably not be able to grow well, and then finds himself having to sell them off because he can't afford to keep them. He didn't think long term. He didn't ask one of the most basic questions, which is, can I afford to keep this portfolio if interest rates go up 3%, 4%, and 5%? That's one of the most important things investors need to do. to say, is it because of the situation that people are having to sell off their portfolio? My answer to that is no, it's not because of the economic situation. It's because they didn't do the basic due diligence and groundwork, and they didn't inspect their own financial circumstances well enough in the first place to establish whether they could continue to hold that portfolio through the tough times as well as through the good times.
We connect you to the best real estate information across Australia. The Real Estate Podcast.